Wall Street. This is this terrible, evil place you should never trust with your money, yet sometimes, and most of the time, people do. Think about the movies. Wall Street. It's a movie about legalized white-collar crime. Wolf of Wall Street. White-collar crime, but with more drugs. Boiler Room. White-collar crime, even more drugs, and Ben Affleck for some reason. Seriously, what do you think's scarier? Wall Street or Elm Street? A Nightmare on Elm Street 16. Freddy's back, and this time he's your broker. I'll slash your net worth in half. Oh, God, it was so stupid I couldn't even finish it. So dumb. Couldn't do it.
Wall Street does not have your best interest at heart. Shocking, I know. Just watch any film, and they have never, ever been the good guy, let alone the hero. They tell you it takes money to make money. Yeah, your money, not theirs. They tell you high risk equals high return. You take the risk, they get the return. They tell you you're in it for the long haul. It is the way they get to haul off with your money the longest. If you don't know about this, Wall Street will continue to steal your money. Does Wall Street have a brand you trust in any other business? Wall Street Hospital, get your surgery. Hey doc, was the surgery a success? He's like, it depends on your definition of success. I mean, totally success for us. We got paid. Not so much for you because you lost a kidney. Wait, it was just a routine knee scope, right? How about Wall Street Airlines? You taking that one? Hey, sometimes our planes go up, sometimes they go down, but overall they mostly go up. I mean, I remember my first trip to New York City. At the time, I was selling mutual funds and I wanted to learn more about them. It was a full week that I was in New York and I was in for one hell of a surprise. The game changer for me was offering to drive Barbara Treadwell from the conference in New Jersey to her apartment in New York City. See, I was attending this 2-day advanced course. I had to kind of work my way in because I was a rookie, but I made friends with the receptionist and the wife of the person presenting, and so I found a way to attend this advanced course even though I didn't have all the credentials. And when I offered to drive Barbara back to Manhattan, I just grilled her with a ton of questions. She'd been in the financial industry for a really long time, and that really gave me this chance to learn. I asked her question after question, and she continued to school me on risk and investing, actually giving me a stomachache. My stomach was churning. She was instructing me on questions to ask for risk mitigation and risk management. So I went to Park Avenue Securities in The Guardian. I was introduced to all these different people, and I took these little questions that she gave me. I actually wrote them down on this little red memo pad, right? Like I'd flip it and write down the questions. And I'd start asking questions like, well, what's the downside? Or what could prevent this investment from working? And then I really started to think, maybe I'm being manipulated or marketed to in an unrealistic situation with an unsustainable rate of return that would motivate me to buy or even sell these types of things. So after that drive, I was equipped with new questions going into my full day of meetings at Park Avenue Securities. I got to admit, driving around New York City was intimidating to me. Being in this massive building close to Wall Street was pretty surreal. Kind of reminds me of a story I told my son recently after our trip to Vegas. We're in Vegas, and I said, son, these buildings were built by gamblers. Who do you think won, the company or the person at the table? As I look at these massive buildings everywhere, I felt the same way. Now, as I'm in New York City, being from a little rural community growing up, I was a fish out of water. But my day with Park Avenue Securities was filled with mutual fund managers, the trust division, and even some actuaries on the insurance side. I was in for one hell of a day, right? But it was really from this guy on the product development side that could finally answer the questions Barbara gave me. And when the dust settles, and even though my stomach had been in knots, I realized 7 truths about money Wall Street does not want you to know. Number 1, doesn't take Wall Street's money to make money. No. It takes your money for them to make money. That's why they tell you you're in it for the long haul, right? That's why they tell you high risk equals high return. I'll get to those here in a minute. They're getting a percentage, not only on your money, but everyone else's money that's out there. You have a finite or limited amount of money and a finite or limited return, but theirs is more unlimited based upon how much money they can get in management and get a percentage off all of that. It doesn't take Wall Street's money to make money. Number 2, high risk doesn't equal high return. They take no risk. You take the risk, but they get return whether you make money or not. Now, obviously, if you make more money, that's good for them because there will be more money for them to invest. But if you make a lose or don't make any money in a year, they still get their fee. So they're not taking risk. You are, and yet they're getting return. Number 3, you aren't actually in it for the long haul. You aren't in it for the long haul. Let me break that down. Number 1, what percentage of S&P 500 businesses fell over time? There's businesses that used to exist decades ago that are no longer in business. And yet, when that business goes out, they just replace it with another company. So maybe 499 businesses make it in a year, but that one business that fails, you have a 0% return permanently on 1/500th of your portfolio, but they just replace it with another company and act like that new return is what you get. But remember, you lost permanently with that one company. So you got to think about it. What percentages of companies default or go out of business, or bonds default or go out of business? See, you aren't in it for the long haul if there's massive disruption. You aren't in it for the long haul if you have financial trauma, or you have financial circumstances that change, or surprises that come along the way. And we're all in for financial surprises. It's just a matter of, are you going to have to confiscate part of your money, or part of your retirement, or part of your investments to handle that? They want you to be in it for the long haul, because the longer you're in it, the longer they're making money on your money. It's crazy. All right, here's another truth that Wall Street doesn't want you to know. Small fees equal big differences in outcome. When it comes to investing, you have expense ratios that pays the fund managers. You have 12B1 fees, which gives money into these mutual fund companies and Wall Street companies to then market and bring in more money. And the difference between, if you have $100,000 earning 8% over 30 years, you get almost $1 million in earnings. It's like $900,000. But if you only get 6% instead of 8% because of your 12B1 fees and the expense ratios, it's less than $500,000. It's like $474,000 in earnings off your $100,000. So it cuts it in half just off of 2%. So it seems like a small fee, but it has a massive impact. Number 5, volatility crushes your overall outcomes. Think about this. If you have $100,000 and you lose 10%, now you're down to $90,000. Now, if you make 10% the next year, you're only at $99,000 before you've even paid for your fees, and you're now 2 years in and not even at the place that you started. So that 2 years has a major impact. Those fees have a major impact, but volatility crushes your overall outcomes. And unfortunately, when you turn on the news is going, oh, the market's rallied. We've earned our 10% back, but it's 10% of a smaller amount of money because of the loss. So that takes us to the 6th thing that Wall Street doesn't want you to know. Average returns and actual returns are two very different things. Average return doesn't have to include expenses. It doesn't have to take into consideration the volatility. So those are number 4 and 5 that we just talked about. But let's think about it. If we have $100,000 and we make 100%, that's amazing. It's at $200,000. But maybe you had to pay tax on that. Don't know. Depends on if it's in a qualified plan or not. And then the next year, what if you lose 50%? So your $100,000 grows to $200,000. Now you lose 50%. You're back to $100,000 if there were no fee, if there were no tax implications here. So what's your average return? Well, if you had 100, and that's your positive, minus 50, you're back to 50. Divided by the number of years, which tells us an average, you get 25%. That's a 25% average return, but your actual return is 0 or possibly negative if there's fees involved. So average and actual are very different things. So they're using all these mountain charts, they're using averages, and then there's a little asterisk that says, in the fine print, well, average and actual are different things. But they don't want you to know that. They want you to buy based upon emotion, based upon things that are not factual. And the 7th piece, right? So we started, it doesn't take Wall Street's money to make money. High risk doesn't equal high return, because risk means chance of losing, and increasing your chance of losing can really harm you. And they're not taking risks, they're having you take the risk. You're in it for the long haul because some businesses fail. Small fees equal big difference in outcomes. Volatility can crush your overall outcomes, and average and actual returns are two different things, but this is the thing they really don't want you to know. Money isn't lost, it's transferred. Money doesn't evaporate or disappear. It goes into the hands of someone else who might be in the know. If you ever watched the movie Margin Call, it's really about Goldman Sachs during the craziness of 2008. And if we look from 2008 till today, guess what? They're up thousands of %, and so many people had money that evaporated from their account, but it ended up in someone else's hands. Whose hands did it end up in? The very, very few wealthy that are playing a completely different game with hedge funds, and they're selling short, and they're using derivatives, and they're using all of this information. And I wrote an article in Forbes that talked about 84% of the returns in the market go to 10% of the investors. It's not just the size of investment, but it's because they're using different instruments. When we're just buying for the long haul, and we're just waiting, there's other people that are selling short, and they're making money when the market goes down, and that was money that you thought you lost. It was transferred into someone else's hands. So money isn't lost, it's transferred. These are 7 pretty big truths to understand that Wall Street doesn't want you to know. It doesn't take their money to make money, it takes your money. High risk doesn't equal high return because you're taking the risk, they get return. If you make money, they'll make more, but if you lose money, they still made their money. And by the way, they could even get bailed out. You aren't in it for the long haul. Some businesses fail. Small fees, which sounds small, have huge outcomes in actual dollars. Volatility can crush your overall outcomes. Average versus actual returns are two different things, and money isn't lost, it's transferred. This was mind-blowing to me as I'm figuring this out, as I'm sitting down. It gave me a stomachache because I'm like, wait, I've been selling them based upon average returns. I didn't think about what happens when a company goes out of business inside of a mutual fund. I was always talking about things without looking at the actual expenses. I was doing things from 1998 to 2000 that weren't in the best interest of my clients, but I didn't know any better because I was following the narrative of Wall Street. This narrative of separating you from your money, of them making money in the most leveraged fashion with taking the least risk, and if they mess it up bad enough, the government bails them out. The system is rigged. It's time to opt out of that system. Invest in yourself. Develop your skill sets. Figure out ways to create more cash flow. Pay off loans that are inefficient so you free up that cash flow and free up your peace of mind. Figure out how to create financial independence and create assets that create cash flow and stop taking risk to benefit Wall Street. This is part of the solution. Watch other videos that I can help you out with this. And I got to tell you, I have a great thing called the Mega Kit. It takes my book, Killing Sacred Cows, which is 9 financial myths and helps you see through them. It takes What Would the Rockefellers Do, and it's one specific strategy that helps you to become your own bank and ultimately take back control of your finances, and then 7 ideas around how to create more cash flow. Those are just a few of the things on me. Well, I guess in exchange, you give Wealth Factory your email so that every now and again they could try to sell you something, which is hopefully selling you on a better philosophy to take back control of your finances. And so I don't have to always yell on these videos because I get really excited about this stuff because it's frustrating. I want to make sure that you know what's really going on. And when you see past the lies and the myths and misinformation and get to the truth, you can make better, more informed decisions. You know, most of the time when we think we have a money problem, money is the symptom. See, there's other forms of capital, our mental capital, our relationship capital. So you might be one idea or one relationship away from the next level of prosperity. But only when you can find out what the obstacles and what the errors are when it comes to our financial matters. That's what we're doing here at this channel, helping you navigate this crazy complex world of money in a way that taps into those hidden resources. And when you become more resourceful, you'll end up with more money that you can enjoy today and in the future. So check out this next video and you'll be well on your way.